Today is a good day to take a breath. I mean, I think when you look at what's going on, 325 on the 10-year is not a dangerous level. What's concerning to the market is that we went from 305 to 325 in the space of 3 days. And the market's going to take a break when that happens. But is it justified? You know, has inflation spiked since a week ago? No. No. I mean, wages were growing this year. We started the year growing 2.7% year over year. We were at a whopping 2.8 in the last jobs report. We still have a core PCE that's right at the Fed's target. And while I know that there's some concerns that Powell's comments have signified a more aggressive Fed, we don't think it's the case. You still have 3 dots in that dot plot next year, and we're not sure they're going to achieve those 3. I think it's time to take a breath, and we'd be more inclined to buy here than sell. We think this has gotten overdone on both the bond and the stock side.
Our thinking has been that the market would dip before the midterm elections, not because of the midterm elections, but because of this backdrop of the Fed hiking with a lot of global uncertainties, particularly because of trade. That's why I wanted to be in front of you this morning. My thinking is that this is a dip that's already a little bit oversold in terms of versus S&P fair value. But I think we have just a little bit more to go downward before we bounce higher, because U.S. equities are not oversold versus foreign equities. Europe is being beaten up quite badly, 15% decline from its highs. And emerging market Asia, on the pressures of these tariffs, which we think are going to get worse, that is down well into bear market territory. At this stage, we think it is a dip to buy. Of course, you always have to wait for the dips in order to be able to buy them. Our view is that buy big banks, stick with growth stocks in the United States, and try to buy some of the value opportunities you see abroad.
What's interesting about yesterday, if you paid attention to the market action of yesterday, is that it was really tightly contained in equities. So when you looked at, everybody wants to talk about what happened with yields yesterday, the yield curve actually steepened. That's a bullish sign, right? And we're at 32 basis points now. You're heading into a good seasonal point of time, obviously November, December, into the spring. And if you look at the signs of stress in markets, right? Credit default swaps, OIS spreads, very well behaved, right? They just didn't show the signs of stress. So when you get that type of action just in equities, I agree with David. I think it probably creates more of a bullish sentiment against the fundamental backdrop. The other point I would make, too, about the Fed is, remember, it's not just the Fed that's tightening, right? You've got, interest rates going up, you've got balance sheet shrinking, but you've got oil prices until 2 days ago were at 4-year highs. You've got the U.S. trade-weighted dollar up 10%, which is a tightening or constraining of financial liquidity. So there's a number of factors at play here that are all working to tighten financial conditions simultaneously.
I think we should probably see another 5% downside with these larger names. I think Apple's going to be a positive outlier, just given its valuation, but I think we should see another 5% drop here. Still very bullish on the sector more broadly for other reasons, but the near term, this psychology has a way of playing itself out in historical patterns, and that's what the historical pattern would tell us. More broadly, we think that there's going to be really a split in how the FANG is going to perform. Companies like Facebook are going to underperform the FANG over the next year, but I think Apple and Google are probably in the best camp. Again, that Amazon, that high multiple is probably going to be a challenge.
So I'm more bullish today than I was a couple of weeks ago, and I was bullish a couple of weeks ago. I think the things we want to focus on are earnings, which are still healthy in the U.S. Valuations have come down quite aggressively. Positioning is probably washed out at this point. I mean, I think what's interesting about the sell-off over the last few days is that credit has remained remarkably calm, despite this big move in the VIX, despite this big move in the market. So, I guess if we start to see rates stabilize, if we see credit not necessarily imply that this is contagious, I think those are all positive signs for equities. Tech, I think, was the most crowded sector in the S&P 500. I mean, it was, a 30% overweight by the average fund manager.
So you think it deserved?
Part of that was just a positioning, a risk that is now has been removed to some extent. I think within tech, you want to buy cash-rich tech companies, and you want to sell some of the more growthy, credit-sensitive areas of the market. I mean, I think the rule that we want to pay attention to over the next 12 to 24 months is that cash yields are rising, so cash all of a sudden becomes more important and leverage becomes more evil. So anything with credit sensitivity I would avoid, and I would buy cash-rich, large, healthier companies.